Hi there, Cokie here with Wink, what investors need to know now. This week, I know why you're here. You were here because you wanted to hear all about how BO cannot be bad, right? Is BO always bad? Not necessarily. I also want to talk about Got Milk. So I don't know if you heard this morning's 411 Live. It was all about Got Milk. And I've got a great analogy that I hope is going to come into play here today. I wanted to make this a little interactive. Last week we talked about Warren Buffett. I gave a few tips on best investment advice. We're continuing the theme about best investment advice here today with BO and milk. And so here, I'm going to make this interactive, and I'm going to move around and hopefully give you something more that you can bite off and chew this week. So BO, when is BO good? I'll tell you when. So I want to talk about what I think could be some of the best investment advice you could ever have, which is to sometimes utilize a strategy within investment or security selection called relative strength or momentum investing. Now, I should have given a huge caveat. Here's the deal. If you're a stock picker, just turn this off and move on. You know how to do what you're doing, and you're probably really, really good at it, so you should stick with that. And by the way, you probably do use relative strength and momentum in your strategies, so kudos. This message is really more for investors who want to know a little bit more about how their advisors may or may not be picking best in breed stocks for their portfolio. So here we go on BO and relative strength investing. And I'm going to make this into, and I hope you can see this, it's sort of a quadrant, because what we want to do is separate out winners from losers, okay? So if you could take an entire universe of stocks, and honestly, we start with about 900, and weed out those that you know are not going to outperform the S&P 500. And this has been proven and looked at for 20, 30 years. I've been using the folks at Dorsey Wright & Associates, now owned by NASDAQ. This has been my resource. This is my black box. I have used them for this data religiously since the early 2000s. What you can do is you can weed out, we'll start with a universe of say 900 stocks. You can find out which stocks are on a buy signal, and you don't need to think too much about it, but you want to look at stocks that are on a buy signal and in a column of X's, and we call this BX. You with me? Then there's another category. Those are those stocks that are on a buy signal, but they're in a column of O's. Maybe they're not doing quite so great as the buy stocks in a column of X's, but these are buy stocks in a column of O's, and we call these BO. So those are not so bad. They're not as good as here, right? And then going further, I think you're with me, you can go get stocks that are on a sell signal in a column of X's and in a sell signal in a column of O's. Now, what does all this mean? All it means is if you had a tool that was available to you, or your advisor had a tool that could take a look at all the stocks within a universe that you wanted to look at, whether it was high yielding stocks, which is what I really want to focus on today, because I think some of the best advice you could get, investment advice you can get in this market, has to do with yield and investment returns in a space that helps those investors who may be a little worried about, is the market going to have an exhale? Or you're retired and you don't want to necessarily put all of your money in high relative strength or high momentum stocks. That could be quite aggressive, right? Well, we have a strategy that can take all of this 900 universe of stocks we talked about. We can pare that down to about 300 stocks that are buys in a column of X's. We'll look at buys with a column of O's. BOs are not so bad, but we're going to start looking at all of the stocks that are buys in a column of X's, because we know that these stocks consistently outperform the S&P 500. That's what we want. But what if we go one step further? What if we go one step further and say, now I only want the highest yielding of these stocks, meaning those that are going to pay my clients a nice hefty dividend. That's what clients are looking for right now. So the best investment advice I think today for you has to do with BO and BX, and this concept of minimizing the idea of the universe of stocks. So I want to bring home a real example. A client called me last week and said Xerox. The yield on Xerox is, and I've forgotten it and I put my phone down, but the yield on Xerox is, and I'm going to make it up, I think it's around 5 or 6%, and I think it'd be great for that dividend. That's a great dividend. Well, have you ever heard of the saying about catching a falling knife? Do you want to catch a falling knife? No one wants to catch a falling knife. That's going to hurt. You're going to get cut, and it's not going to end well. Now, I'm not going to necessarily say that Xerox is not going to be a great stock for you in the future, but suffice it to say, if you were to look at Xerox's chart, it's going here. It's going down. It is not in a buy in a column of X's. It's not even a buy in a column of O's. Xerox is on a sell, okay? So just because a stock has a high yield and the price keeps going down, which is, by the way, its yield is so nice and high because the price has gone down, does this mean this is a stock you want to buy? I say no. I say let's go to this universe of 900, let's pare it down to 300, and let's find 30 to 50 of the highest yielding stocks. So the name I give you today is Marathon Oil. And again, this is not necessarily a recommendation to buy, but when you look at Marathon's price performance, boom, Marathon is up, I want to say 59% year to date. Contrast that with Xerox, which I think is down 16% year to date. Marathon stock yields not 6%, probably a hefty 2%, and is a buy and a column of X's. So this is the universe you want to be focusing on. You want to focus on the winners and not necessarily names that may seem attractive, because again, it might be that you might be catching a falling knife, or it might be like a Xerox. And again, I could be wrong about Xerox, but if you can improve your chances by staying in this quadrant, buy in a column of X's, and how do you do that? You could simply just ask your advisor, what is their methodology for choosing best in breed stocks, best in breed high yielders, best in breed relative strength, high momentum stocks that have low volatility with low standard deviation. This is a possibility as well. So I made a promise I'd also bring in Got Milk to the story. It's a story that goes along with the idea of yield, because right now, again, clients are they're enjoying great investment returns, but some are in retirement and they're seeking a safe haven, and they've had great equity returns. So they're looking for bonds or high yielding stocks that can perhaps buffer the idea of some equity losses. And so I use this analogy, and I've used this analogy for over 2 decades, that a farmer goes out and he buys a bunch of dairy cows. And he buys these dairy cows because he knows if he gets 10 cows, he can milk those 10 cows and he can sell that milk. And the price that they can get for that milk is enough to fund their retirement every single month, month in, month out, for the rest of their lives. So the farmer goes to the store one day and he sees that the price of beef has plummeted. And he comes home and he says, Mabel, the price of beef is now $3.99 a pound, and last week it was $19.99 a pound. I'm really worried that our dairy herd is worth a whole lot less, and maybe we should sell our cows. To which Mabel says, why the heck would we sell our cows? They're still producing the milk, okay? So if you get my story, is if the price of beef plummets and the price of milk is still stable, your income and what you're receiving is still fine. So you may have a Xerox that has plummeted, and you need to make a good decision as to whether or not, why would you sell it? If it's still producing the milk that you still enjoy, and you don't really have a fear of, say, Xerox or your bond defaulting or going out of business, then maybe you hang tight with that particular security. But I think the bottom line with this whole wink edition for what investors need to know now is that you can liberate yourself. You can get this information about dynamic investing and having a portfolio that doesn't always have to be set it and forget it in stocks and bonds. You can entertain ideas of, say, high momentum, high yielding stocks in a best of breed equity portfolio, for example. So there's only 4 steps to becoming a liberated investor. It's pretty simple. We've been talking about those other steps in other episodes of Wink, but you can get your download today. That is available at alphavest.com. So again, alphavest.com. Download Liberated Investor. It's free. It's 13 simple pages. And I also want to invite you to subscribe to our weekly newsletter with 411 and Wink follow-ups and reposts. So we always appreciate your feedback and engagement. And thank you for joining us. Again, get liberated today. Download your Liberated Investor, and we'll see you next week for Monday 411 Live and what investors need to know now. Thanks for joining.